Well, good morning, everyone. Today you've got myself and Peter Barker on the phone, and as for the last few results presentations, Peter and I will tag team this one. I'll introduce the company and go through some of the early slides, and then Peter will give the middle of the presentation, and then I'll sort of finalise it, and then we'll ask for any questions. So let me start off on page 3 and performance and review for 2018. Look, we're very pleased to report we gave guidance earlier in the year of a 25 to 30% increase in performance on the prior year, and we achieved that. We came in at 28%, $56.2 million when the guidance was given of $55 to $60 million. It's been a really good phase for Cardno. We're coming out finally out of our restructure phase, and we're very much moving into a phase of stability where we're focused very much just on incremental growth, driven by both business optimization and accretive acquisition. We've put a little phrase here, simple and boring, because that's exactly what it is. There's nothing that we're planning on doing that's going to be a material step change in the business. We think we've got a very good foundation now from which to grow. And what we want to do is really just focus our energies on where we can optimize our business from a margin or growth perspective organically, or where we can actually supplement our existing business from a strategic acquisition, whether it's picking up a geographic set of offices, a new product adjacency or service, or something that's going to complement our existing business. If I try and hit the highlights on this page, as I mentioned, EBITDA growth was up 28% over the prior corresponding period. Very pleasingly, we had a very strong cash conversion. If you exclude tax and capital structure, which is interest expense, we ran at about 95% to our EBITDA, which we're very happy with. Balance sheet continues to remain strong. Our net debt to EBITDA is down at 0.3. Really gives us the flexibility to think about our growth from here. Also pleasingly, the Americas division is starting to see a rebound in performance. We've seen EBITDA margin there as a group move from 1.6% to 4.8%. Now, while this is still below where we would like to see the business, it's certainly trending in the right way, and we do think it's genuinely got some good positive momentum behind it. And our expectation is this trend will continue. Unfortunately, we had a reversal of this trend in the Asia-Pac engineering business, where we've seen our EBITDA margin decline from 10.9 to 7.5 as we continue to roll off some of our major projects, as well as some project provisioning in APAC North as we went through a restructure of that business. I don't think our expectation is that this isn't expected to decline further from here. We think we'll be able to hold this and start to build on it again. But certainly the building is going to depend on some major contracts that we've actually bid for that we are yet to determine whether we have actually won them. Further than that, and I'll come into this on some following pages, through the second half of this financial year, we went through a material restructure of the North and South business in Australia. And the main drivers of that was to increase and build a framework for collaboration and revenue opportunities across the business. Initially, we were anticipating on waiting for that restructure for Andy Goodwin to settle in. We for some time have felt that we needed to rebalance the business in terms of how it was structured in Australia from last year. However, we were waiting for the new CEO to take the reins. When we unfortunately had to let Andy go, we decided we weren't going to wait any further, and we sort of moved ahead with that restructure. Although early days, and I'll talk about it on the following pages, we're pretty excited about how it seems to have been accepted by staff and early traction we're getting. Construction Sciences had a fantastic year, continued to perform very strongly on the back of elevated infrastructure work. It's a good market and it's a well-run business. Those two have led to a very strong performance in that division. Our development business as well has sustained a strong level of performance through the year and has also built up considerable backlog coming into the new year. Again, we have a well-managed business with a very committed group of staff that have achieved some really good numbers this year. Also pleasingly, our oil and gas business, PPI, based out of Texas, returned to profitability in Q4, and we expect this trend to continue. They've gone through a very material restructure in terms of services provided to customers and clients over the last 2 years, moving out of certain businesses and pulling back and scaling back their business from high-cost oil countries such as Nigeria, We're through that now, and we're actually starting to see some genuine green shoots. Again, the management team that are running that business have performed a very strong task over the last couple of years, and we hope to see that trend continue. Our Latin American business, in particular Camanosca, continues to be in wind down phase. There's not much more to say there, but that wind down continues, and we're operating within management expectations. We're hopeful to be able to report over the next 18 months a sort of a full exit out of that Camanosca business, but we'll see how that pans out over the coming period. One of the other things that we did in the US in the second half of this year is restructured the US business. We have 3 divisions there under Susan Riceboard. Susan was the divisional president for our science and environment business. Going forward, she's double hatting not only as the president of the science and environment business, but also with broader responsibility for the region. And pleasing to say, backlog as a group grew by 9.7% exiting the year. If I turn to page 4, and to just take it a little bit of this further forward in terms of what's our focus going into FY19. I can honestly say I think from an organisational restructure perspective, both in Australia and the US, we're largely complete. So we don't see any further material restructure costs running through the P&L. Key focus for the business now is really simple. It's returning all the divisions to organic growth. It's expanding our EBITDA margins across all divisions. We've invested considerably in BD costs through 18 and 19, which will see some of our businesses not grow in the way in which we would have anticipated or the markets may anticipate. That's more to do with the lag between costs being introduced and the revenue profit benefit that we expect to get out of that. We're continuing on with our strategic bolt-on acquisition process, really around, as I mentioned, gaining access to geography, skill sets, or service lines. We're also spending a lot of money at the moment through 18 and 19 on IT and digital investment. This is really designed to step change the business in terms of how we can engage not only with our clients but also with staff internally and increase productivity. We're early days into this project. We've got some major milestones that we anticipate to close out through calendar 18 and into 19. But we're very hopeful that that's going to leave us in a very strong position in terms of our ability to service clients. And then finally, we're really focused on executing on greater collaboration across offices with clients and staff. Now, I know a lot of that sounds like motherhood, but that's really what we're doing. We're just focused on the basics and really looking to drive and optimize performance across our business over the coming 12 to 18 months. If I turn to page 5 and look at some of the divisional level key milestones that we've been able to execute on. If I look at each territory in turn, and starting with the Asia Pacific, we very much focused on restructuring and aligning the operations in the 2 divisions to capitalize on collaboration and client opportunities. What we were finding was they were operating too much as silos, and there was a limited collaboration, both from the perspective of thinking about how they can resource share, as well as how they thought about clients. We've changed that very much and moved to although we still have very, very direct ownership of each P&L on a geographic basis, we've gone to a soft matrix structure around key service lines, which we're trying to use to enable a stronger sense of collaboration. It's early days, but we're very buoyed by what we're seeing in terms of outcomes of both staff and how the businesses are engaging. Separate to that, we had to change out leadership in our APAC North business, really to create a stronger growth environment. We were stalling in that market, and we were uncomfortable with where we were seeing the business travel. So we had to make some leadership changes there. And then finally, we've done some small bolt-on acquisitions in the Sydney market to continue to complement the business. In America, it's been a story about margin, cost, and structure. As I said, margins have been improving. We've been focused very strongly on cost, and we're also pleased to say we had a considerable cost saving coming out of reviewing how we were managing our US benefits program. And then we've actually simplified the operating structure in the US market to create a very senior resource on the ground to also help optimize decision making and quickness of decisions, both in terms of clients and market and the way in which the businesses operate there. Our ID business this year has been all about building a platform for growth and business development. We have seen some material growth across the business in terms of new contracts that have been won, positioning of our business. We've been spending a lot of time and resources building out our European beachhead. And with Brexit, we've had to split that and look to both an office structure to deal with the European Union, and as a separate office structure and engagement strategy around dealing with the UK. Separate to that, we've been investing heavily in BD resources in every single market, the US, Europe, and Australia, to continue to promote our business. And again, although it's early days, we're seeing some strong outcomes there in regards to new projects that are being won and the size and materiality of those projects. Construction Sciences has been just a real tale of a good tailwind in terms of sector, well-led, continue to probably lead this market in Australia. And at the same time, we've seen some nice little acquisitions that have been able to complement the existing business that we've been able to get away in the past year. PPI I've spoken about. It's really been a reset to a more robust business, and we're starting to see emerging demand from our clients, which I think bodes well for FY19 and FY20. And LATAM as well, as I mentioned, it's really been about a continued wind down, and that's been running to plan. And we're continuing to see the progress that we're anticipating from a group level in that market. If I turn to page 6, it's been a similar story about rebuilding momentum at a group level. I'm not going to go through each of these in turn, but we're very much focused on the granular about how we continue to optimize this business. And that means at every level we're thinking about how we optimize our business, both in terms of how efficient we're running our business, but also how we actually engage with the operating parts of our business at a group level. So we've seen some really strong initiatives at a group level, both across finance, human resources, health and safety, marketing, audit and training. And all these go to building a strong platform for the future and driving a consistent level of performance. On page 7, just briefly touch on Ian. After the problems with Andy, we think we found a very strong candidate in Ian Ball. Ian started with us last week, and we believe he brings considerable skills to the role. His first 8 weeks are going to be spent on a global onboarding program, learning the business, after which he'll be responsible for the business day to day. We're giving him the benefit of just getting around the business before we start asking him to make decisions. In the interim, the business will be still run by myself, and sometime in October, based on when that orientation finishes, Ian will take the reins of the business. We wanted to do it this way because we run a very broad global business across many countries, many offices, and a considerable number of staff. And we felt the best way to get Ian to engage is to actually learn the business in the first instance, give him the opportunity to do that before we actually start asking him to make decisions. His previous roles, we think, set him up very well for what we are. At the end of the day, we're a services business. Ian comes from a very strong pedigree of running at a very senior level some of the leading service businesses in the world. His last roles at EY, we think, bode extremely well for some of the challenges that we face as an organisation and some of the challenges that Ian was dealing with at EY. And prior to that, his roles at Silver Lake, IBM, and working as a strategy consultant, we think also bode well for the skill sets that we're looking for the role. On the right-hand side here, there's a little table which is headed "Fit for Role." When we put the brief out to our executive search firm, we're very focused on what we wanted to see. We actually said very clearly we want someone that's run a business of a similar scale or larger. We want someone that understands how to run a portfolio of businesses, multi-stream businesses, because we're not just one business and we work in different markets. We wanted someone that could actually develop and think about executing a growth strategy, not only focus on what the business does today, but what the business should be in the future. And we want someone that's looked at cultural change and so that can continue on with the journey that we've already started in the organisation. We want someone that can actually understand how to optimise our operational systems and processes so that we can think about how we can get better. And we don't mean that only has to come from someone that works in the engineering consulting space, but we want someone that's looked at services businesses more broadly. We want someone that's got a track record of business development, someone that's got a track record of M&A, someone that comes out of the service industry, and preferably an engineer or scientist. And as you can see, we've got a tick against Ian's name in each of those boxes. And we think that bodes really well for the skill set that Ian brings to Cardno and where we think Cardno is in its current journey. Now I might hand over to Peter to take us through the financial review of this presentation.
Great, thanks very much, Michael. So moving forward to slide 9, our full year financial highlights. As Michael said, EBITDA came in for the year at 56.2, which is in the guidance range which we had given of 55 to 60 million. Look, across the board, looking at the table on the right, the bulk of the numbers there are green bar top line. And Michael's already spoken to the initiatives that we have in place and have underway, both for organic and small bolt-on acquisition-led growth. So I'm quite encouraged by both of those. Going down, you'll see a net loss after tax there. That is a non-cash charge associated with the change in the US corporate income tax rate from 35% to 21%. That legislation going through in late calendar 2017. So as we have substantial deferred tax assets in the States, you need to revalue those. The benefit from those reduces from 35% to 21%. So that's what that is. It then creates obviously net profit before tax is up substantially. It does actually put us into a loss for the year. And as Michael said, pleasingly, backlog's up 9.7%. We are reporting backlog on a total contract basis. And so it's up 9.7% from just over 1.3 billion to 1.432 billion. And as Michael said earlier, excellent net cash from operations. Moving forward to slide 10, this is the walk from our net operating profit after tax through net profit after tax. And NOPAT, which is the first column there, is our, if you will, our profit from ongoing operations. And that's a very pleasing $20 million. Now, we break this out for absolute clarity. You can see the large bar, the $32.8 million. That is the non-cash entry associated with the change in the US corporate tax rates. We did also have some business review costs, and specifically I draw out we did take a provision associated with the wind down of the Kamenovska business in Latin America of $8 million. Pleasingly, it's offset by a number of items which went the other way associated with provisions or accruals where, for instance, onerous leases, we were subsequently able to settle the matter and thus released an accrual. The really pleasing thing about all of this is that these tables were quite substantial over the last few years, and so, if you will, the list of abnormal items is reducing day by day, which gets back to Michael's theme of ongoing. It's consistent, or we used the term boring in the earlier pages. Moving through to slide 11, which shows our performance for the last 4 halves. I draw your attention to line 3, EBITDA from continuing operations. We're really pleased with the EBITDA from the 2 halves in fiscal 18, so 30 million in half 1 and 26 million in half 2. Pleasingly, both of them are up year on year, and I've already talked to NOPAT being up as well. Moving through to slide 12, this is our 2018 full year segments. Now, the first thing you'll note is that compared to prior years, Construction Sciences is now its own segment. It has become sufficiently large that we chose to break it out to provide additional clarity, and it's simply that large that you need to break it out now. And as Michael said, they are actually having a superb result at the moment and looking really good. In terms of headcount, we did also break out, and I draw your attention to international development. A number of their staff are contingent workers, so we've specifically shown that there. Going through then and looking at each of our segments specifically, so on slide 13, as Michael said, we've had the Asia Pac business it's really a story of 3 things. Firstly, a number of major projects wound up in early FY18, so they were significant to us in fiscal 17, and obviously they're not there for fiscal 18. So that's impact number one. Impact number two, we did a pretty substantial scrub of the North Division associated with some project cleanups. They're very much in the ordinary course of business, but they did nonetheless impact the result in the North. And as Michael said, we did restructure Asia Pac to create a platform for ongoing growth, which again we're also quite pleased with. Moving then through to slide 14, which is the Americas. Now, we are showing the same scale on all of these graphs, so a very encouraging result here in the Americas, realising, as Michael had said earlier, they're not yet at the profitability which we would like to see associated with being consistent with industry best practice, but they're certainly heading in the right direction, and we're very encouraged by that. Really pleasingly, we were able to take out some costs during the year, which are non-client facing, management and labour firstly, but secondly, some fringe costs. Now, fringe in the States is insurance, employee insurance and employee health, and some excellent work there by our employee benefits team actually resulted in us being able to increase the quality of the services that we provide to our employees at a fairly substantial reduction in cost. And pleasingly, that's locked in for the years ahead. So very encouraged by that. Coming through to international development. Now, as we've said in the past, ID is a comparatively low margin business, and the key drivers there are the quality and size of the backlog, and we're very encouraged by that. And it is a long, slow bidding process, i.e. bids can take many months, if not years, and once you have won a project, you tend to have it for a long period of time. So as Michael said earlier, we are investing as we respond to large tender processes, primarily in the Northern Hemisphere and primarily in the UK. So that's when Michael referred earlier to investment in BD. That's a good example of that. Coming through to slide 16, Construction Sciences. They are really benefiting from the backdrop of an improving infrastructure market in Australia and some excellent acquisitions and execution in that market. So a really good job by our leader there, Matt, and his team primarily around Australia, but also in New Zealand and a small business in the United States. We do reference 2 small bolt-on acquisitions. They are not material, but they certainly expand our presence. One of them is in New South Wales, one of them is in Queensland, and they expand both in one instance our presence and in another instance our technical capabilities. So really pleased with those. But I can't emphasise enough that that business is executing well, and it's reflected in their results. On portfolio companies on slide 17. So this is our oil and gas business, PPI, which is based in Houston, as well as our business in Latin America. PPI actually has been very much a turnaround associated with the challenging oil and gas market and a refocus of the business to focus primarily on quality assurance and quality control, as well as the historic engineering. That strategy is proving to put some runs on the board. They had their first profitable quarter at the end of FY18, and we're quite encouraged from the business outlook for the next year. So really, that was a long burn, that process of turning that business around, and we're really pleased with the way our team led out of Houston has executed on that. Latin America, we continue to work through the roll-off of major projects there and mitigating the risk. And as Michael alluded, we are anticipating being able to execute on our strategy there in the next 12 to 18 months. If I move forward to slide 18, which is our balance sheet, we're really pleased with reduction in inventories, reduction in trade debtors through working capital management, etc. Though I do caution that we have large clients who can make $10 to $20 million payments in any given year, and it might come in before, say, on the 25th of June, or it might come in on the 5th of July, or it wouldn't be the 25th, the 27th of December, or the 4th of January. So we are conscious of that large lumpy payments of that size can change the structure of the balance sheet in terms of working capital. You do see the change in deferred tax assets coming through, a reduction there, and a small increase in intangible assets associated with the acquisitions we made during the year. And as has been the case for the last few years, we are well inside our covenants and have plenty of headroom there. On a further slide on balance sheet strength on page 19 is a different cut of page 18, so I won't pause on that. I'll just move on. On to slide 20, our cash flow report, which is my favourite slide in the entire deck. Cash flow from operating activities, $45.7 million, so encouraging there. Reduced interest costs associated with less debt. Very small amounts of income tax paid. We do have substantial deferred tax assets, so the conversion of EBITDA into cash is pretty strong for the year, and obviously we're very pleased with that. We bought two small acquisitions during the year for $10.7 million. Our share buyback was $14 million, and we did use the opportunity to reduce debt by $11 million. So again, a pleasing outcome for the year on cash flow. But I do draw investors and stakeholders' attention to the lumpiness of some of our large client payments, which can swing this on any particular given year. With that, I'll pass it back to you, Michael.
Thank you. So I'm on page 22, everyone. FY19 for us is the third year of our multi-year business improvement plan. As I've already mentioned, the focus of the business remains the same, which is really focused on cost control, organic growth, investing in our people, and where appropriate, looking at strategic, accretive bolt-on acquisitions. The first bullet point here, the focus of the board is on returning the business to positive organic growth. Look, we're still investing to drive medium-term growth more than anything else. We think at the end of the day, this business needs to develop an engine for growth. And what we've been doing up until now is really sort of peeling back the onion and making sure that we've got the business where we want to. We do now, and now we're in a position where we're going to just start demanding more of the business on an organic growth perspective, but we can't do that without being willing to invest at the same time. The focus on strategic acquisitions is also, it's just starting, but we're quite interested in this. It was one of the things that we thought that Cardno in its early life did very well, which was think about how they could optimize their business. As we've described in prior reporting periods, it kind of lost its way when it started going and doing acquisitions which were off strategy. But to us, you know, picking up a team in a particular discipline that we might still be underrepresented in, or picking up a team or a business that has a good geographic coverage in a particular area that we're wanting to build out to us has a lot of sense. And we're looking at that, and we're looking at that right across all our operating business units. The internal investment into systems and process improvement for us is also a key area of focus. And that's as we've described here, focus on business development resources, IT, training. The IT and BD resources in particular are two themes that we're following through this year. We've got to bite the bullet and spend the money to develop our business on an IT platform perspective. And we're really focused on that over the next sort of 12 to 18 months. And separately to that, we've got to put the right people in place to really drive the engine of this business, and we're doing that as well. And that really leads into the fourth bullet point, where we talk about the fact that we're looking to spend another $15 to $20 million in CapEx this year. We are still CapEx heavy. We are still recovering from the ills of the past, where basically the company underspent its CapEx. We have to sort of right that ship, and I think our feeling is that this is probably the last year of a overspend on CapEx, and what we should expect to see is through 2021, it dropped down to a lower level of capital expenditure. But certainly this year, as we're sort of in particular building out our IT platforms, we're going through a heavier spend than we would normally expect. Anticipation is that we'll continue on with our share buyback. As far as the board's concerned at the moment, we still think that is a better way of optimizing capital and value for shareholders rather than looking to pay out a dividend. And separately to that, we still don't sit on a franking balance to suggest that paying out a dividend would be helpful on that front either. And just finally, one of the other things that we'll be looking to do this year is our debt facilities come up for renewal in about 14 months. We're starting that process now, and we'd hope through the second half of this financial year we'll lock in place some new debt facilities with some longer tenure. So we're kicking off that process now as well. So if I leave you with sort of two closing statements, Cardno is operationally and financially probably in the strongest position we've been in the last 3 years. The company believes there's a solid basis for revenue and EBITDA growth in the medium term, and hopefully what you've been hearing from Peter and myself is just a real focus and strategy around optimization and investment and to drive to create that outcome of that EBITDA growth in the medium term. And that's very much what we're profit guidance every year, unless there's a material change in performance. We have, in an earlier presentation, I think at the half year, given an aspiration guidance of where we would like to see the business trend over time, but that will be driven by how well we execute both on an organic as well as an acquisition strategy. But certainly from here, our focus is, our belief is that we've got a good momentum to continue to see the business perform and grow. And I think on that comment, I'll probably pause and see if there are any questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Wasim Kursawani from Deutsche Bank. Please go ahead.
Good morning, guys. Can I just start with a question on the Asia-Pac business and the major project work in that business? Going back to the time of the half result, you were tendering on quite a number of projects, and just interested in how that's played out, and what the sort of current pipeline and sort of tender activity looks like in that part of the business. Yeah,
look, Pete, you can jump in here as well. Wasim, we're still waiting to hear on a number of those major projects. So a number of the projects we're tendering on, they've got a very long digestion period. We expect to hear on a number of them in this first half. We don't know how we're going to go. So typically we're on a consortium panel. We get down to the last 3 or 2, and there are several projects, material projects for the company that we're down to the last 2 at the moment. Whether we'll end up winning that or that consortium will end up winning the work, we don't know. Just to give you a sense, it's very much led by the construction guys in the sense of the final price that they put into the process. So towards the end of the process, we become more of a passenger in that process rather than the decider of the outcome of the tender, if that makes sense. So it's as much for us to work out getting on the right consortiums as it is to being able to influence the final outcome. I can say what we've found is on one recent project which we were unsuccessful with, we ended up circling back with a consortium that won that project and ended up becoming a subby into that project, providing engineering services work that their own consortium couldn't complete or were going to have issues around capacity. But we haven't got anything material to report on that front. Did you want to add anything to that?
Michael, I think that the thing to add is we are working through our business such that the major projects are a sweetener rather than a material driver of our business going forward. So I would anticipate going forward that if we are talking major projects, it's been a wonderful upside rather than a core driver of our business.
Yeah, I think that's a really good point.
Okay. Great, thanks. And can I just final question from me? Just get maybe.
Sorry, Wasim, before you move on, just to give you a sense of context, we win projects every single day, and we're winning lots and lots of medium-term projects which we just don't classify as material, and they might be $3 million, $4 million, $5 million in fees, which is still a material project in our business. It's just not the 20s and the 30s or the 50s, if that makes sense.
Sure. No,
so it's all a quantum. So our business day to day is doing extremely well. It's just, as Pete says, some of those cherry on top projects, which kind of give you a new base load of work for a period of time, we're sort of work in progress on those.
Sure. And then just finally, can I sort of just get you to clarify some of the outlook commentary? Sort of just a bit mixed in the sense that you do sort of talk about added investment that's needed over FY19, limiting EBITDA growth, but then we've obviously seen the backlog of work's up substantially. I think earlier on the call you said you don't expect any more margin deterioration and that you could perhaps build on that margin. So just sort of wrapping it all up, and then in the context of the target you gave at the half, around 10 to 15% growth for 19, or the aspiration for that sort of growth. Can you maybe just sort of provide a bit more clarity around what that expectation looks like now?
Yeah, it's the same. So we still have an aspiration that we should be looking to grow the business by 10 to 15%. Whether we achieve it or not, that's certainly the way in which we think about our business in terms of how we should travel. It's not guidance. I need to be really clear on that. We're not giving that as guidance, but certainly from our perspective in terms of how we're thinking about our business, that's what we believe we should be able to achieve over time. Now, it might be up a little bit or down a little bit because it comes from two elements. One of it will be organic. The other element of it will be some of these bolt-on acquisitions we're talking about. So if we don't find, or we can't agree on price, or we find through diligence that some of those acquisitions that we're looking at don't travel, then the number clearly falls away. If we find, as we've said, some of those additional projects come online stronger, then it gets compensated. So it's a bit of a mix. We certainly don't think we'll be trading down in the coming year. We think we'll be growing through the coming year. It's just a question of how we're going to finish. I think we'll have more ability to give some views on that at the half rather than starting out the year. But starting out the year, we certainly think that the business is in good shape to do well in the coming 12 to 24 months. Pete?
No, I fully support that, Michael.
Okay, and then just to sort of clarify finally, just on those comments around added investment, sort of tying that comment up with your ability to hold and sort of improve margins over the coming year, where are you expecting to see some margin deterioration in sort of one division in particular that sort of underpins that cautionary comment, or can you maybe just clarify that a bit?
Pete, do you want to answer that one?
Yes, certainly, Michael. So we're seeing I think you should take that as a directionally, we'll have some businesses that are up, some businesses are down. So for instance, we talk about investment in business development in the international development business. So the nature of that is in the UK at the moment, the British DFID, which is the British equivalent of DFAT, our ID folks, our ID leader, Marion Borland, tells me that she has never seen DFID so active in terms of putting out a request for tender. So the investment on Cardno's part to participate in these tenders is quite substantial, and many of them have 3, 6, 9, 12 months lead times before the award is actually made. So that's a good example of investment which, all things equal, will put a little bit of strain on our development business's results for this year, and it's an investment that, as Michael said earlier, we're really quite encouraged with.